Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
I really love how you put out the entire process, because these are, I think, very integral elements in an LOI. And, when it comes to LOI, I often hear people talk about the binding part versus the non-binding part. That really seems to be confusing a lot of people. So what does that actually mean?
Yeah, be careful. Most people think, oh, the LOIs are non-binding. It'll even say sometimes in the very first paragraph, this is a non-binding LOI, which typically means in lawyer speak that you're not signing a contract that you can be sued on. You're not signing anything that binds you legally to an obligation that you have to sell the company, or you have to buy the company, or more importantly, you have to buy the company for this price, or for a seller that you're going to receive this price. Price is usually non-binding on a letter of intent. So sellers, please know that, to say, well, I've got a letter of intent to sell my company for $1 million. That term is usually non-binding. However, towards the end of an LOI, there will usually be a paragraph, and it will say, these items in this LOI are binding. And what are they? Usually confidentiality. You guys are going to agree as a buyer and seller that the terms that are on the paper are confidential and you won't discuss them with anyone. You're also going to normally agree on the choice of law or the arbitration being binding on you, to say, okay, if someone breaches confidentiality and we're going to sue in Texas, then we've agreed to sue in Texas. And then finally, a term that is usually binding on the parties is what we call a no shop provision, saying, seller, you've agreed that buyer is going to buy you for this amount.
Welcome to another episode of your favorite podcast, Accounting M&A Insider, podcast where we break down the mechanics and the madness behind buying and selling accounting firms. I'm your host, Saul, and today's episode is one you'd want to flag, save, and probably replay when you get serious about doing a deal. Joining me is Roman Basi, president of the Center of Financial, Legal, and Tax Planning. Roman has been guiding buyers and sellers through the legal maze of M&A for decades. And today, he's going to walk us through a step-by-step legal playbook for firm transactions from LOI to closing and everything in between. Roman, welcome to the show.
Thank you. Thanks for having me.
Absolutely. So, Roman, before we get into the nitty-gritty, can you tell our audience a bit about your background and how you ended up in specializing in legal advisory for M&A?
Sure. My background is, now that I'm a lawyer, I'm a CPA. I've got a master's in business administration. I'm a managing real estate broker, and I'm a title insurance agent as well. So I hold a lot of titles, of course, but those developed over time for me. And how I got into the practice was after I got out of college. I was working on my master's in business administration. I really didn't know what I wanted to do. My father had a small law and accounting firm, doing some consulting to small businesses across the country and doing a lot of writing and educating and researching. And so then I joined him with my MBA, and later on I went to, then of course I went to law school to join him in his law firm, and eventually acquired my CPA license. And slowly but surely, that advisory and that consulting that he had been providing to companies across the country resulted in what we do now, which is advising and consulting to privately held companies across the United States on mergers and acquisitions, succession planning, estate planning. We now have a separate law firm, a separate accounting firm, a separate real estate entity as well, with lawyers and CPAs and real estate brokers. So it's grown over the years. but that is really how I started out working in the field a little bit, got the education, and then I've been doing it now for 28 and a half years. My father and I still work side by side after that long.
Wow. Wow. That's phenomenal. That's phenomenal. And your experience of guiding so many firms, when it comes to accounting firms, the accounting firm deals specifically, what makes them different from, say, I don't know, retail or manufacturing transactions?
When we're dealing with an accounting firm, I mean, it becomes all about the taxation in the transaction and how we're going to structure a transaction and what we're looking at in terms of revenue and recognition of revenue. And again, tax structures and legal structures and how we're going to put the deals together. So it becomes very interesting from that standpoint, and where the customers are coming from, and where, what the contracts are, if there are any contracts in place, and what that residual income is looking like. So that's how those transactions will differ quite a bit. But then again, we do a lot of transactions across every different industry, and being involved in merger and acquisitional activity as an accounting firm, we get really interesting too, because it's such a nice little slice of a piece of what we do when we look at a deal. And I put together a cash flow of the transaction to be able to show an owner, from an accounting perspective, an owner who doesn't necessarily know how an acquisition takes place, or how a merger takes place, or how a transaction or a succession to the next generation takes place, to be able to show them the entire waterfall or cash flow of a transaction from start to finish, starting with the selling price and looking at adjustments, and then looking at the asset allocation or the stock allocation. And we'll talk about that a little bit later today. And then looking at the taxation of the deal. And then we're not done yet. We're still looking at payment of liabilities, post-closing matters like employment agreements, consulting agreements, non-competes. We get to show them this from top to bottom, down to their wallets. And what an eye-opener it is for owners across the country when we're showing them, hey, look, when you sell your company, when you sell your firm, when you sell your practice, this is what it's going to look like from an accounting perspective. All of a sudden, they really start to understand the nuts and bolts of M&A work and an M&A transaction. So really, that's how that's what really changes. And when they see the legal complexity that's brought into the accounting complexity in that waterfall, they've never probably seen that in their practices necessarily. That really opens up a lot of eyes for them.
Interesting. It does feel like there's an additional layer of complexity involved when it comes to dealing with accounting firms, because there's so much of the value is tied to the trust, and often the firm owner themselves. That's how these deals are being structured. So it's a very people driven connections, relationship driven deals that happen here. So let's start at the beginning. When we talk about legal prep, what kind of legal prep should buyers and sellers do before even drafting an LOI?
One of the very first things that I do in every transaction, if I'm representing the seller or the buyer, I'm going to look and make sure, are you incorporated in the state you are saying you're incorporated again? Again, thinking about this from the buyer side or the seller side. Is your company in good standing? Have you filed your annual reports? What area, what states are you operating in? Are you operating in two states, but you're only really incorporated in one state, and you need to be filed foreignly in the other states that you are operating in? So I will first look at that. Are you in good standing? Are you incorporated in those states? Now, the next question I ask is, are you dealing with a person of authority? Am I dealing with you, the owner, if you're the seller of the company? Are there other principals involved? Are there other minority principals involved? I just had a transaction where we sold a car dealership, just again, relating it to this issue of preliminary work before you draft a letter of intent. There were two owners, a brother and a sister. And lo and behold, the sister had priorly been divorced and had given a certain small percentage of ownership to her then husband, now ex-husband. Once we found that out during the transaction, no one knew this prior to the letter of intent. So it's those types of things that you want to, educate yourself on as an owner, to say, hey, am I dealing with the right people? Are they in good standing? Is it an active corporation? Who's the owners of the company? And are there any other parties that need to be part of this? Now, also from a seller's side of view, and really from a buyer's side of view, but more importantly, from a seller's side of view, one thing we want to make sure we have before we're even looking at a letter of intent is we want our sellers to have recasted financial statements. We don't want to be handing a buyer blanket, raw financial statements. So preparation is key before we go into any type of letter of intent. And those are really my highlights there. What do you want to be looking at when you're preparing to potentially go into an LOI situation?
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
True. I mean, that's really interesting. And with the LOIs, there are two other documents that are often floated around when it comes to any deal, and those are NDAs and confidentiality agreements. So, and what about them? What do you usually recommend there in terms of NDAs and confidentiality agreements?
What we're going to look at with the NDA most often is, first of all, what is the term of confidentiality? What is the buyer? Typically, a buyer these days will present the NDA, even though historically, our sellers, we would put together a presentation package or what we call a confidential information memorandum, and we would send out our NDA with a nondescript letter wanting our NDA signed on behalf of the seller. These days, what happens most often is a buyer will potentially come back with their format of their NDA. The very first thing we want to look at is, what's the term on the NDA? Is it only 1 year? Is it 2 years? Is it longer? Is it less? So that's the first thing we're going to look at. And then we're going to look at, when we're negotiating that term, we're going to look at what is the statute of limitations of a written contract in that state that we're working in. You're going to probably hear me say that more than once today, because that's really a trigger for a negotiation sometimes, is what's the statute of limitations going to say about a written contract? How long is this going to be enforceable? Regardless of what we put on paper, how long would the state we're working in make it enforceable? And so then, of course, we're going to want to mark them up. Other initial document prep that we want to be concerned with, and this just happened recently on a transaction as well, where a broker, a intermediary, presented us with a contract that supposedly a third party had produced on behalf of both a buyer and a seller. And supposedly the seller's attorney was out on vacation and the seller wanted someone else to review the contract for them. And when we reviewed the contract, we pretty much found out that this broker and advisor had prepared the contract using some type of artificial intelligence contract generator. And I just want everyone listening to know that if you're out there and you're preparing a contract on behalf of someone else, that's a legal liability. That's the practice of law. When we found that out, of course, then we looked at the NDA and we said, hey, wait a minute. Where did this come from? Who put this together? Why are we looking at this right now? So we take them serious, but we also want to look at them. We want to look at their term. We want to look at how they were drafted, who drafted it. Finally, one of the things we want to look at in the NDAs and any initial agreement is choice of law clauses. What choice of law clause is in that NDA? Why is it so important to me to look at it right now? It may not matter really that much for the NDA. In my 28 years of practice, thank God, knock on wood, I've never had a violation of an NDA. However, that choice of law clause sets the stage for the rest of the documents in the deal. So if you're in the state of Texas and you see choice of law of Ohio, you may see me say, no, we don't want Ohio law. We either want Texas law, maybe we want Delaware law. Why am I negotiating the choice of law so early on? It's because that sets the stage for the negotiation of the choice of law throughout all the documents. And also, I'm a big proponent of arbitration. I want to strike a choice of law clause and put in an arbitration clause. That's going to be one of my biggest highlights in an NDA is trying to get arbitration into the deal very early. Why? Arbitration is quicker, it's cleaner, there's less litigatory matters. There still can be discovery, but in general, it's a quicker resolution and a cheaper resolution for the parties as opposed to going to state or federal court. So those are my highlights on confidentiality agreements and initial documents.
I love it. I really love it. I really love how you brought out, they're very subtle things, but the devil is in the details, right? So it's very subtle, but I guess very integral nonetheless. And thank you for pointing that out. So let's shift the focus now to the the three-lettered word that you often hear in the deals, LOI, the letter of intent, right? Everyone treats them differently. So what should a strong LOI include from a legal standpoint?
Typically, they can be pretty generic sometimes. I even had one where we sold an auto dealership, but it was a one-page letter of intent. But me as a tax attorney, what am I looking for in the LOI? I am looking for the tax structure of the transaction. How is a buyer, or if I'm representing the buyer, how are we proposing the tax structure? Is it an asset sale? Is it a stock sale? Is it going to be some type of hybrid sale? Is there going to, and now from a seller's side, maybe they have the tax structure in there, and they will often, especially with accounting firms or other type of professional firms, they may use the terms, we're going to give you some rollover equity. We're going to give you, the seller, some tax-free rollover equity. Those are the four words that we always see in a professional LOI. The very first thing that pops into my head is how. How is a buyer proposing it to be tax-free rollover equity? I want to see their structure. I want to analyze their structure. Unfortunately, I sit here and have to tell you about 90% of the time, if not more, once we look at it, we tell the buyer, yeah, that's not going to work. That's going to be taxable to the seller. And the buyers will turn around and say, you know what? You're right, Roman. We didn't mean for it to say tax-free. Let your seller know, and then we'll move on from there. And typically we can move on and we can negotiate from there. But I want the parties to know, are you proposing a true tax-free rollover equity structure, or are you not? Second thing that I'm going to look for in a well-drafted LOI, or I'm going to try to put in there, is how, if it's an asset sale or we're going to have asset treatment, who's going to allocate to the deal? If I represent the seller, I want to try to propose that the seller is going to propose the allocation. Why? This drives the tax structure. This drives the taxes on the deal. Whoever is proposing the structure is getting the first shot at their best position. So in a well-drafted LOI, if I'm representing the buyer, then I want an allocation paragraph in there on behalf of the buyer. Seller, it's the reverse. And then again, we're going to talk about a choice of law clause, arbitration. And then finally, something to think about in a well-drafted LOI is a transition clause. Start to identify, because every seller gets extremely nervous about the transition. They are excited about the deal. They see a proposed closing date on there. And then as they get closer to the transition, they start to really get nervous of, well, how are we going to do this? We got 1 week left, and I've got this lease or this bank account, or this has got to happen. So we want to see what the transition, the cleaner the transition proposal, the more comfort a seller is going to have, and the more success we're going to have on the deal.
Wow. I really love how you put out the entire process, because these are, I think, very integral elements in an LOI. And, when it comes to LOI, I often hear people talk about the binding part versus the non-binding part. That really seems to be confusing a lot of people. So what does that actually mean?
Yeah, be careful. Most people think, oh, the LOIs are non-binding. It'll even say sometimes in the very first paragraph, this is a non-binding LOI, which typically means in lawyer speak that you're not signing a contract that you can be sued on. You're not signing anything that binds you legally to an obligation that you have to sell the company, or you have to buy the company, or more importantly, you have to buy the company for this price, or for a seller that you're going to receive this price. Price is usually non-binding on a letter of intent. So sellers, please know that, to say, well, I've got a letter of intent to sell my company for $1 million. That term is usually non-binding. However, towards the end of an LOI, there will usually be a paragraph, and it will say, these items in this LOI are binding. And what are they? Usually confidentiality. You guys are going to agree as a buyer and seller that the terms that are on the paper are confidential and you won't discuss them with anyone. You're also going to normally agree on the choice of law or the arbitration being binding on you to say, okay, if someone breaches confidentiality and we're going to sue in Texas, then we've agreed to sue in Texas. And then finally, a term that is usually binding on the parties is what we call a no shop provision, saying, seller, you've agreed that buyer is going to buy you for this amount. It's not binding. We're going to do some due diligence, but you've agreed to it. And in the meantime, you're not going to accept any other offers. You're not going to advertise your business for a period of time. And that's what's called a no shop provision. That is usually a binding provision. So those are the real big differences in binding and non-binding.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Wow. I would usually say that the LOA is like the trailer, not the movie. But if the trailer's bad, nobody wants to watch the rest. So, thank you. Thank you for, laying out at least, what's critical in this LOI. So thank you for actually distinguishing that, because, I hear a lot of people, even when they come into my PE webinars, they're talking about a binding and a non-binding. And, you're right. A lot of them, like, this is the non-binding, and they're like, wait, if it's non-binding, how does that work?
Right. And that's
But why should I even sign it?
Scary for most sellers. They come to me and they say, "Oh, I signed an agreement to sell my company." Then I, have to explain to them, well, it's actually non-binding. The price can change. And once they see that, I mean, most often that's the case. 99% of the time, that's the case, is you're going to sign a non-binding letter of intent, unless you go straight to a purchase agreement. And some of the smaller transactions will go straight to a purchase agreement, and that can be a binding situation.
Yeah. That I've seen that happen. I've seen that happen because sometimes it's very straightforward. It's what it is, and you directly get to the purchase agreement. Though I don't see that happening too often, but yeah, that does happen. But after the LOI, pray that you have been through the journey. You went through the NDAs. The NDAs were good. You had all the due diligence. You checked everything off. Just like Roman is saying, the governing law, the arbitration, confidentiality, you look through it all, everything is good. You got an LOI passed through, and that's where the real show begins, the due diligence, because that's where things can get really crazy. So what's the legal framework for running a clean due diligence process?
I love the question, because when I'm talking to an owner, and I will do 3 to 4 phone calls a day talking to owners that are thinking about selling their company. That's one of my, after 28 years, that's one of my main jobs in the company now, is to take the initial phone calls, and then a lot of my team handles the work for me. But one of the most important things I like people to know about due diligence. So now you have a letter of intent that has been signed and agreed to, or a term sheet, terms have been agreed to. Due diligence is discovery. You are discovering items that the seller, you're asking for and discovering what the seller has. The seller is now opening the front door and showing you their house. And where we tell the sellers is we say, you know what, that becomes you're not representing to the buyer yet. Due diligence is not a legal representation. Due diligence is discovery. Here, you've asked me and I've given you these items. What happens, I want everybody to know what happens with due diligence and why I say it the way I say it. Due diligence and those materials then get attached as schedules to the final definitive purchase agreements. That's what makes the legal representation. So sellers have to know, hey, look, what I'm doing in due diligence, I'm going to do it again when I have to prepare the schedule. And that's why a buyer makes a seller prepare the schedule. Sellers get so angry, right? They say, why do I have to do this again? Why do I have to put my AR on a schedule? Why do I have to put my assets on a schedule? The buyer already has this information because it wasn't the legal representation. Now, what's important to discover in due diligence? For a buyer, you're really trying to you're doing essentially what's called a quality of earnings analysis. You are trying to figure out, are the earnings as the seller represented they were. Is the seller's EBITDA accurate? Is it good? What do we want to find out in there to determine if it's good? And what's the real big part of that? Revenue recognition. How are they recognizing their revenue? When are they recognizing the revenue? Is it in the years that they say? Because that's where the typically in due diligence, that's where a misrepresentation is going to occur, is in the revenue recognition part of the discovery process. And so a buyer is saying, look, I want to make sure that these earnings are accurate, that they're good, that one of the things we look at is, are contracts valid? If you have a contract with an entity or a governmental entity, is the contract valid? When does it expire? What does the revenue go to if it renews, terminates, expires, has to be renegotiated? We're looking for those items in a due diligence process. From the legal side, we're going to open up those contracts and say, are they valid? Here's another thing in due diligence we look at. Is there a change of control clause? What that means is, if you've got a contract with someone, and in the contract it says, if this contract is valid unless you sell substantially all the company or there's a change of control, then this contract terminates. So again, we're looking for those legal terms in those revenue items. That's the best way I can try to explain it.
Wow. No, and I kind of think that kind of makes sense, because if at all there is a contract which has got this, which would mean that, whatever terms you have with that vendor as a seller, if you may be having good relationships, you may have negotiated some rates and that's working out well for you. But if there's going to be change in ownership and that change of control clause is there, it means that the buyer will probably need to step into the shoes and renegotiate with that vendor. Whereas the entire deal was structured on assuming that what is working till now is continuing to go to work for a considerable period of time, right? So that's what's there. And we have had buyers uncover, I've also had buyers uncover things like, undocumented contractor relationships, or, unpaid sales tax. It's wild how often, there's basic things that get missed,
That's
but
right. And we're looking at also looking at the length of relationships, and especially with an accounting firm. We're saying, hey, what's the length of relationships? How long have you been doing the financials or the returns or whatever the firm has been doing for them? That's going to build value for the buyer. That's what they want to see. That's what their offers are based upon sometimes. So, and where can the growth occur? Where's the market share? Those are the things that we're looking at as well, especially with an accounting firm.
Yeah, it is very interesting, especially when we got accounting firms are usually a lot of it. It's an attractive option for a lot of people because of that recurring revenue that they continue to see. But and that's why like the way our industry is at right now, we're going to be seeing many accounting firm transitions happening in the coming years. But we're not going to talk about that. We're going to be checking on the legal aspects of it. And if you're lucky and everything was great, your house was in order and the due diligence went through, that's when the purchase agreement comes in. This is where things get really interesting. It all boils down to this, right? So let's talk about the actual deal docs. What are the most important clauses that every buyer and seller should really understand in this purchase agreement?
And don't be surprised with these purchase agreements. They can be, a short one can be 20 pages, a medium length one can be 30 to 40, and the larger ones are 60 pages plus. So those listening want you to know that, be prepared. You've gone through LOI, you've gone through due diligence, and now you're waiting on these purchase agreements, and they can be very, very long sometimes. And what are the key clauses now that we're looking for? If tax allocation wasn't in the first one, wasn't in the LOI, where is it now? That's really, I'm going to key right in to the tax allocation clause. I'm going to key into the non-compete clause. What's the non-compete telling us? How many years? What's the geographic radius? What are they allowing us to carve out of the non-compete? What are you going to be allowed to do if you're not going to continue to work for the company? If there's going to be a post-closing lease? Maybe you're the owner and you're leasing the building back to the buyer. What is the lease obligation? And is it the same as the letter of intent? I have one going on right now where the letter of intent said it would be a triple net lease. When the lease came in 2 days ago, it said, no, the landlord, we want you to have some insurance, and here's what we want you to have, and we want you to take care of the roof, the HVAC, the utilities coming to the building. Well, that's not really an actual triple net. So what are the lease obligations within the purchase agreement? What is, if there's going to be an earnout or a purchase price adjustment? Now I'm going to key right in on that language. Why? An earnout is ordinary income to the seller. A purchase price adjustment can be taxed as capital gain to the seller. Now, yes, the IRS will look at what are you doing as a seller post-closing, regardless of whether you've called it an earnout. And for accountants, we need to know this. Whether you've called it an earnout or a purchase price adjustment, the law side of this is going to say, what are you really doing as a seller? Are you really part of the earnings of the business post-closing? Then it's going to be considered an earnout no matter what you call it, and it's ordinary income to you. But have you stepped away? Have you sold the company? And if the EBITDA goes up or whatever the target is, are you going to be allowed to get more money? Then we can call it a purchase price adjustment, and you can receive capital gains treatment on it.
Yeah.
So those are the clauses I'm going to target.
Very, very interesting. And, in fact, this was a topic that was also discussed in our last PE webinar that we did just recently last week, reps and warranties. So let's unpack that for a second, right? Why do they matter so much?
Reps and warranties become really your attestation to the agreement. You as a seller and you as a buyer is relying on this, and the seller is attesting and saying, I am representing that this is my company. This is my valid data. I have filed my tax returns. I am not being sued. I have all these employees have been paid, and there are no payroll taxes owed, no employee obligations outstanding. The reps and warranties are the seller's now legal attestation. It's legal representation to the buyer. This is correct, except for what I've put on an additional schedule. If you as a seller cannot represent something to a buyer, we put it on what we call a disclosure schedule. Then we say, hey, except for this, all my employees are good and none of them have a lawsuit outstanding against the company. So that would be something that you would put on there. We talk about indemnifications as well. And when we talk about indemnifications, then you're able to limit your exposure potentially as a seller for those reps and warranties. Some of the reps and warranties will be what we call fundamental. And most often you won't be able to limit your fundamental reps. What's a fundamental rep? I am a company, I am incorporated in this state, and I am in good standing. That's a fundamental rep. Or I have filed my tax returns. That's a fundamental, and I owe no taxes. That's a fundamental rep. Those are going to probably withstand a limit on an indemnification. And I want you to understand what a limit is. In an indemnification limit, sometimes we can negotiate what's called a basket and a cap for a seller. So first of all, to have a claim that would be payable to a buyer after a closing, you've misrepresented something, the claim has to fill the basket. And sometimes that's 1 to 2% of the deal. It can be less than 1% price-wise. That is the basket that we create. You're not liable until the basket's full. And then sometimes there's a cap. And we say, hey, the buyer can only get back the cap. And the cap can be 20%, 25%, 30%. These are all negotiable. They all change via industry. But it's a way that we limit a seller's exposure to the reps and warranties. And that really is how all of that ties together.
Oh. And from your perspective, how do you approach the decision between an asset sale and a stock sale?
We love it. We get, of course, as accountants, as CPAs, often a CPA tells their client, not just their own companies, but often a CPA tells their client, when they're not in the M&A world, when they're in more of the financial reporting world as opposed to the M&A world, a CPA will tell their client, well, you want to sell your stock because the sale of your stock is capital gain. Whereas an asset sale, you can run into other taxation. And know this from a legal perspective. When we have an asset sale, we are only selling the assets of the corporate shell. We're not selling the corporate shell. So we're not selling a buyer the unknown liabilities. Whereas in a stock sale, you are selling them the unknown liabilities. So if you've done some financial reports for a client and something's wrong with them and you sell the stock of your practice to someone else, then that client decides to sue. The buyer then becomes on the hook for that work that was done improperly. That's why in a stock, we don't have as many stock sales to third-party buyers as we do asset sales. When you're selling your practice to an internal person, a key employee, a family member, most often that's going to be set up as a stock sale because that person knows what the liabilities are. They know the clients. They know if there's going to be a potential claim down the road. However, in some circumstances, and this is a topic for another day, in some circumstances, in some cases, we can actually do both. We can have an asset and a stock sale combined. We can get asset sale for tax treatment, and we can get a stock sale for legal treatment. There is actually a hybrid Internal Revenue Code section. There's several of them that we work with. Again, topics for another day, but just to throw the numbers out for all of you, there's a 338H10. That's an asset sale for tax purposes, a stock sale for legal purposes. There are things we call F reorganizations that do the same sort of thing. And in an F reorganization, we can provide tax-free rollover equity. So why do we do these things? We have these really creative tax structures sometimes when we have contracts that we don't want to transfer, but we want to get asset treatment, but we have to sell the stock. Then we look at these hybrid perspectives from a legal view. So I just want you to know, the answer to what's your view on these is really we take a look at both on every deal. What's best for the parties? Is it best to sell their assets or is it best to sell their stock?
Interesting. And I definitely agree to you in that because we have seen some deals that blow up because someone didn't fully grasp the tax or the liability impact of one structure over the other. So I do agree to you on that. You definitely brought in a very interesting point.
It's exactly.
And
Someone called
yeah,
us last week that they told me they were selling the practice and they were structuring the entire thing as a royalty payment. When I look, as soon as I'm on the phone with the buyer, who was the longtime second in command position in the firm, and I was like, you do know that that's going to be all ordinary income to the seller if it's structured as a royalty payment. And that caused them just again, they don't think about, yes, maybe that worked for them in their minds, but was that really going to work from the seller from a tax perspective? Was that the legal term royalty really isn't the way to go when you're selling a practice? So that's why we look at everything as a whole.
very interesting. And okay, so now that we've covered it all, we are at the finish line. Okay, the closing is there. So what are some legal boxes that need to be checked at closing?
Yeah, don't forget these. First of all, if it's an asset sale, we're going to change the corporate name. Most likely the buyer bought the corporate name of the business. So we're going to file a corporate name. We're going to transfer all the intellectual property, websites, trademarks. Don't forget, you're probably selling your phone number. Even if you carved out a part of your business, you've probably sold your phone number. The reason why I have these answers sometimes, you can probably tell, it's because where we've had trouble with deals over 28 years. I know where all my little pitfalls were. And one client didn't know that they were selling their phone number, and it became a real rub between the buyer and seller. So those are real big legal steps. We're going to change the corporate documents at the state level. These are really big steps that we have to make sure are done.
True. I mean, the phone number thing, don't even get me started. I've had that. And, I had this deal wherein a first-time buyer and, wanted to grow and there was a practice up for sale and that happened. But this was very weird because the buyer was a first-time buyer and the seller also happened to be somebody in the network. So it was easier for the deal to go through. But to know somebody in the network is one thing, but how well do you know them? Because they were not transferring the number and they're like, hey, okay, I'll just inform everybody else that this is a new number. But that did not go out well, because the sellers retained the number and then they were able to, it got ugly. It got really ugly.
And that's for sure.
All right. So, okay, this is good. And what about some post closing items that people forget or regret not handling better?
Be careful with these again, and I've seen these happen before. UCC filings. So sometimes when we sell a practice, there's a note given to the seller. There's a promissory note with what we call a security agreement and a UCC, which puts a lien back on the company on behalf of the seller. Well, the UCC financing statement has to be recorded in whatever the recording office is with the state. Generally, it's the Secretary of State's office. So don't forget those. Financial data reporting. You might have had in the note, hey, seller took a note on behalf of the company and the buyer owes them monthly, quarterly, semi-annually financials. If there's a note or an earnout, or again, a purchase price adjustment, those are some post-closing documentation compliance items. If the stock was bought, we want to make sure that the stock book is cleaned up, that the stock record book accurately reflects the sale. That way the buyer has a clean set of records to file their reports with the state. Those are things that they really should be looking at.
True that. And for sellers, how can they protect themselves legally during this post close handoff period?
We talked about it a little bit with the LOI. We talked about, I like to make sure that we are discussing transition early on and what has to be done from closing through the transition. Sometimes we will have what's called a transition agreement. Those are usually a very good agreement to have. They're short. They kind of outline things more down to the layman's talk. You're going to answer phones when I call you for 2 months. And you might put in, I'm going to ask you for 5 hours a week that you're going to give me back as the buyer. It's those transitional items within a transition agreement or some type of written understanding of what the parties are obligated to do post-closing to help get through that period.
No, I agree to you. I mean, like, we always tell the sellers all the time that don't just disappear after the closing, right? That the handoff phase is like when most reputational risk actually shows up, So, you want to be careful there. So, Roman, we're coming towards the close. So I actually have devised a quick fire round. I'm just going to be asking you, top 3 legal mistakes to avoid in a small to mid-size M&A deal. So if you could just let me know the top 3 mistakes to avoid in a small or mid-size M&A deal.
First off, the problems that I've seen in the past, number one, all closing items signed off and filed, especially things like personal guarantees. Sellers like to really not sign these if they don't have to, or whoever's signing the personal guarantee, a buyer, if there's a note involved. Excuse me, I said seller, but watch out for those. Make sure if there's guarantees or notes that everything has an actual signature on it, recorded, filed, deeds, things of that nature. Trust me, I've seen it happen. Early on in my career, I had a seller at a table that didn't want to sign off on a document, and that document did not get signed off on. Somehow it got slipped into a briefcase at the closing, and you just want to see these things done. It's a little less rare these days, but it still happens. Make sure that all assets are either being included in the deal or that you have specifically excluded them. Closed a deal once and there was an insurance policy on a balance sheet and the seller had not excluded the insurance policy from the deal. And sure enough, after the deal closed, the buyer demanded the proceeds of the insurance policy to the tune of about $250,000. So this was not a small amount. And then finally, like I gave you the example before, make sure you've got all shareholders signing off on the transaction. Even if you have, people do not understand this, even if you have a minority shareholder or a minority partner, they still have to be part of the deal. They have to be aware of it. They have to know the terms because they always have the right to go to a court and file for dissolution of the practice of the business because they don't think they're being treated fairly as a minority shareholder. You can't just say, hey, look, they're a 5% shareholder. I don't need their signature. I don't need their agreement to sell this company. They have to at least be aware of what's going on. They have to have a say. There should be corporate meetings where they voice their opinion in order to protect the rest of the company. So those are really big mistakes that we see right now in practice.
All right. And finally, like what's one sleeper clause? A sleeper clause that people tend to overlook but can become a huge deal later on.
Even though we focus on accounting practices in this conversation today, it is a clause that's often overlooked, especially because of that. And my answer would be within the representations of the seller, the representation, there's the very first section I go to, the accounting representation in the document. How have you ran your company, and are you in compliance with GAAP? Most small privately held firms will not comply with GAAP. Why? We're writing things off that really didn't need to be in the business. We have add backs. We have seller discretionary expenses. What does that mean? We have not complied with GAAP. So I will go right into that paragraph, strike the GAAP reference, and change it. We have complied with our historical practices of accounting. We will change that representation. The representations get so wordy and they're buried towards the end of the agreements. Sellers don't want to read them anymore. But we will go right into that and strike GAAP in that reference. Sometimes too, we will make sure that the financial statements, maybe we're not presenting them in a GAAP format. Maybe we'll adjust them to a GAAP format. Then we can represent that we have adjusted GAAP financials. We'll often play with that. But that is honestly the number one most important clause that I go to that just people do not look at when they're reviewing the documents.
Wow. I mean, this is, it's a power packed walkthrough. So, thank you, Roman, for being a guest. Before I let you go, where can our listeners learn more about you and the work that you do?
It's easy. Go to our website is taxplanning.com. We're under construction now for a brand new website. So when you go there, you're going to see a legal division, an accounting division, and then my speaking division, because I do speak all over the country. But you can go to our website, check us out there. We do blog on Facebook. We have a Facebook page. You can like and follow it. Then you'll see the blogs come up twice a week. You can follow us you can check me out on LinkedIn as well. You can also send me an email. You can just send it right to my email, which is rbasi, R-B-A-S-I at taxplanning.com. Tell me you want to be on our tax advisory. We will send that to you once a month. It is a short one-page tax legal article written for privately held companies across the U.S. It's one page. You're welcome to share that with your clientele. You can disseminate it any way that you want. Just send me an email. Say, hey, Roman, put me on your tax advisory list, and we will do that. But it's taxplanning.com is the best way to find us. If you ever want to reach out or have a question or have a client or yourself, what you do is just send me an email. Say, hey, Roman, like to jump on a call with you, or have someone that would like to jump on a call with you. We will normally set up a phone call, typically the very next day, with my team and myself on the call with you. We then follow that call up with 2 emails, one from our accounting department and one from our legal department. We have a very efficient process. It's really, really been the ladder for our success over all these years.
Wow. Well, thank you, Roman. Thank you for sharing that, and for everybody who's listening in, I will be sharing the website details and all that in the show description notes as well, so you have that handy. And with that, Roman, I want to thank you once again for being here. It's been a masterclass in what to actually pay attention to during a transaction. So thank you so much for sharing your insights. And to our listeners, if you're preparing for a deal or just thinking ahead, bookmark this episode and reach out to the right legal pros before you get to the table. And with that, I thank everyone for tuning in. Until next time, take care and keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now